हेलो जागरूक जनता, हेलो एक्सक्लूसिव मेंबर्स, कैसे हैं आप लोग? आप सभी का स्वागत है 30th एक्सक्लूसिव मेंबर वेबिनार में। और 30 एक अच्छा नंबर है क्योंकि मैं भी 30 साल का हो चुका हूँ। एनीवे, तो काफी ऑलमोस्ट 1-1.5 महीने के गैप के बाद हम एक वेबिनार के लिए मिल रहे हैं। और आज का टॉपिक अगेन इट इज वेरी इंपॉर्टेंट, वेरी रिलेवेंट, वेरी इंटरेस्टिंग। तो आज हम बात करने वाले हैं पीएफ टैक्सेशन के बारे में। थोड़े टाइम पहले तक इस पे ज्यादा बात करने की जरूरत नहीं होती थी क्योंकि इन मोस्ट केसेस पीएफ पे टैक्स लगता नहीं था, या लगता था तो भी बहुत हाई सैलरीड एम्प्लॉयज के लिए लगता था। बट जैसे जैसे चीजें बदल रही है फिनांस हमारे इनकम टैक्स डिपार्टमेंट के साथ, तो उसी तरह से पीएफ पे भी टैक्स का शिकंजा धीरे धीरे बढ़ता जा रहा है। मैंने इस पे कुछ यूट्यूब पे पहले वीडियोस भी बनाए थे एंड आई थॉट कि मुझे इस पे काफी सारी चीजें, काफी नॉलेज है, सब पता है। उसके बाद मैंने विक्रांत का एक वेबिनार अटेंड किया एंड आई वाज ब्लोन अवे बाय द sheer depth of calculation, by the sheer depth of analysis which he has done on this particular topic. And उस समय ऑलमोस्ट ये 1.5-2 महीने पहले की बात है, तब मैंने विक्रांत को रिक्वेस्ट किया कि वो एलएलए मेंबर्स के लिए भी सिमिलर वेबिनार करें एंड फाइनली ही एग्रीड. So I'll welcome CA Vikrant Pavaskar from Mumbai. Welcome, Vikrant. How are you?
Thank you so much, Rishabh. It's a pleasure to be on your channel. Thanks.
Thank you so much. तो फॉर्मेट हमेशा की तरह सेम रहेगा. हम लोग पहले वी विल गो थ्रू द प्रेजेंटेशन, उसके साथ साथ आप लोगों के जो भी सवाल हैं वो आप यहाँ पे लिखते चले जाइए कमेंट सेक्शन में, मैं उनको पढ़ता रहूंगा एंड टुवर्ड्स द एंड ऑफ दिस वेबिनार हम लोग कुछ ऑडियंस से क्वेश्चंस कमेंट में लेंगे. बाय द वे, अगर आपको आवाज प्रॉपर आ रही है और आप अच्छे से वीडियोस देख पा रहे हैं तो मुझे कमेंट करके जरूर बता दीजिए. विक्रांत, वी कैन स्टार्ट.
Sure. Thanks for this. मैं अपने स्क्रीन शेयर करता हूँ. Okay. Right. I hope my screen is visible.
It's perfect. Yes.
Right. So good afternoon to one and all, to all the participants, or should I say all the Jagruk participants. It's a pleasure to share my thoughts with you on this subject. Right. So provident fund taxation is the topic for today. And in the popular parlance, in the common parlance, PF was considered the exempt category of investment. So EEE, it is normally known that what is meant by exempt is the contribution that is made to the PF account is exempt. The interest that is earned on the contribution is exempt, and the withdrawal at the time of withdrawal, whatever amount is withdrawn is exempt. So that this is the broad understanding of PF, and it is true to most of the people. To most of the people, this fact till today remains true. It is exempt. However, in certain situations, all the three components, that is contribution, interest, and withdrawal, are subject to taxation. And what are these situations? What are these circumstances? So suppose let us take contribution. When is the contribution taxable? When the member's contribution is more than 1.5 lakh. So this is a very obvious thing. Very popular section 80C allows you to deduct employees' contribution to provident fund to the extent of 1.5 lakh rupees. Of course, there are other modes of investment into 80C, but any contribution by the member in excess of 1.5 lakh automatically becomes taxable. The member does not have to do any. The mode of computation itself makes it taxable. Now, employer's contribution in excess of 12%, that is also taxable. So the statutory rate as per the PF Act is 12%. In certain cases, it is 10%, but for generally, it is 12%. Any contribution by the employer in excess of 12% is also taxable. A recent amendment, that is Finance Act 2020, introduced another threshold for taxation of PF. That is employer's contribution more than 7.5 lakh. That is also becomes taxable. So we'll be discussing this in more detail in our presentation. When is the interest taxable? Interest on members' contribution in excess of 2.5 lakh. So this is also a very recent amendment. Finance Act 2021 has made this amendment, and we are going to discuss this at length today. So interest on employer's contribution in excess of 7.5 lakh, that becomes taxable, and interest greater than 9.5%. So this has been there for for quite a time actually. So 9.5% is the threshold, which is the threshold as per the Income Tax Act, over which if the EPFO declares the rate of interest, or even the employer, because a lot of employers maintain PF in-house, if they declare a rate of interest in excess of 9.5%, that is also becomes taxable. Withdrawal, when it comes to withdrawal, yes, it is taxable if the corpus is withdrawn before 5 years of continuous service. So if one falls into any of these situations, then the tax implications are obvious, and the member has to compute the tax and offer that income in his return of income. So the topic is relevant for many stakeholders. It is not just the member who is to pay tax, but it is also for the employers in certain cases where they have to compute the tax deduction at source. It is also relevant. This topic is also relevant for the EPFO to compute the non-taxable and the taxable portions, which we'll be discussing at length. So a lot of stakeholders are involved in this particular subject.
So what are the points I request you to just click on hide this niche next to stop share. Yeah, thank you.
Okay. Right. Now, topics to discuss. I'll be discussing these three topics broadly. One is the tax on interest on employees' PF contribution, the amendment in the Finance Act 2021, which is the most recent amendment, and this was in the news very recently. And then, who are the people who get impacted by the amendment? What is the computation of taxable interest, and how separate accounts have to be maintained as per the new notifications? A couple of illustrations I have incorporated. And what is the TDS obligation on the EPFO or the PF trusts, independent PF trusts, and the taxability in the hands of the member? I'll be also discussing the tax on employers' contribution and interest thereon. The amendment made in the Finance Act 2020, the computation, the TDS obligation by the employer, and the taxability in the hands of the member. And I'll be touching upon the tax on PF withdrawals. So when the PF corpus is withdrawn, in certain situations, the tax is to be computed. So tax of interest on employees' contribution to PF. Now, the Budget 2021 document, incorporated this amendment. Surprisingly, this was not part of the budget speech of the Finance Minister. But anyways, but the budget document gave the reasoning behind introducing this particular amendment. It said that in order to rationalize the tax exemption for income earned by high-income employees, it is proposed to restrict the tax exemption for the interest income earned on employees' contribution to various provident funds to the annual contribution of 2.5 lakh rupees. So it is obvious, that they are targeting a certain section of the salaried class, which they call it as the high-income employees, and the threshold that they have determined is 2.5 lakh. And this restriction shall be made applicable only for the contribution made on or after 1st April 2021. So this is the threshold, and this is the cutoff date. 1st April 2021 is the date on which this provision becomes applicable. Now, in order to justify this particular budget proposal and subsequently the amendment, of course, which it came into force, what they said is, that the top 20 accounts with the EPFO, they called it the high net worth individuals. The top 20 accounts, they amounted to a total PF corpus of 825 crore rupees. So on an average, about 41 crores for every account. The top 100 accounts had a corpus of 2,000 crores, and the top 1,23,000 accounts had a total corpus of 62,500 crores. So what they meant by introducing this provision is a lot of people used to park huge sums of money into this their PF accounts and used to earn a tax-free interest of 8.5%. I think the largest account which they came up, the largest account is of 100 crores actually. That is what they declared in the press conference. But anyways, another statistic that they came up is that approximately 99% of the EPFO members have average annual contribution less than 2.5 lakh. So I think that is one of the reasons that they have arrived at this particular threshold of 2.5 lakh. That what they're saying is 99% people are out of the purview of this amendment. This amendment affects only 1% of the members of the EPFO, and this is there in the Economic Times paper. So the amendment subsequently, when the finance bill was passed and approved, the amendment was in section 10 clause 11 and 10 clause 12. So this is more for the people who are academically interested into as to which provision of the Income Tax Act has this particular amendment. So these two provisos have been added. Now, Section 10, if just to give a brief, Section 10 is the section which exempts the income earned on PF, the Provident Fund account. So, and this has been there for many years, in fact, decades. For decades, this section has been there and has been exempting the interest that has been earned on the PF account. However, with the introduction of this proviso, there is now a restriction. The proviso says that, as we have discussed, that interest earned on contribution in excess of 2.5 lakh will not be subject to this tax benefit, which is there in Section 10. So, in short, interest earned on employees' contribution in excess of 2.5 lakh will be taxable. Now, there are basically different types of provident funds. One of the provident funds is where the employer does not contribute. For example, the general provident fund, where the government employees are part of. So, in case of government employees, the threshold is kept at 5 lakh rupees, not 2.5 lakh. The threshold of 2.5 lakh applies to members who are part of the EPFO and who are members who are also part of the private trusts. Employers also maintain their own trusts. So for all practical purposes, government employees are having this threshold of 5 lakh rupees because there is no contribution from the employer, whereas other employees, they are subject to the threshold of 2.5 lakh. So Section 10.11 and 10.12, these have been amended. Now, a lot of clients and a lot of people ask me, what is taxed actually? Is it the contribution that is taxed or is it the interest that is taxed? So we have the contribution to the RPF. By RPF, I mean the Recognized Provident Fund. RPF will cover a broad spectrum of provident funds. It will include the EPFO also. That is why I've used this term. So recognized trusts, exempted trusts, unexempted trusts, they are all part of the RPF. Contributions made to these funds earn interest, and this interest is then subject to tax. So it is always the interest that is subject to tax, not the contribution. So this slide I've been purposely interested for clarification because a lot of people get confused. So tax is levied on interest earned. However, the trigger for the levy of tax is the amount of annual contribution made by the employee in excess of 2.5 lakh. So now 3 types of contributions come either to the EPFO or to the trust. What are these? We have the employer's PF contribution. We have the employee's PF contribution, the statutory portion, that is at the rate of 12%. And we also have many people contribute voluntary. Voluntary part of the salary goes into the PF account. That is called as the voluntary PF contribution. So these 3 types of contributions come into the EPFO or the trust. We are concerned with only 2 right now for this particular topic. We are concerned with the statutory portion of the employee's contribution, and if he is contributing voluntarily also, that is also taken into our computation for all our illustrations and for all our case studies. Now let us see who are the people who are getting impacted by this amendment. So if we do a reverse working, if we take 2.5 lakh as the employee's contribution, as the member's contribution, and do a reverse calculation, then when the annual PF salary is 20,83,000, that is the point in time when the taxation comes in. So employee drawing PF salary greater than 20.83 lakh will be impacted by the amendment in Section 10 clause 12. So this is the threshold. So anyone having PF salary above this will definitely attract the amendment. There is no way out. Actually. However, people who are habituated to contribute voluntarily also, they may also be attracted by this particular provision, even if they are drawing a salary of less than this. So let's take an example. Let's take someone is drawing a PF salary of 12,50,000, right? Then his statutory contribution, part of the contribution at 12% is 1,50,000. And suppose he's habituated to contribute say 8%. He's contributing 1 lakh rupees. Then his statutory contribution 1.5 and voluntary contribution 1 lakh will total to 2.5 lakh. So this person is also attaining this threshold of 2.5 lakh. Any further contribution, any further increase in his voluntary contribution or any further revision in his PF salary, right, will attract the taxation. So even someone who is earning as low a salary as 12.5 lakh will also be subject to this taxation if he is habituated to contribute to the voluntary provident fund. So people who, the thing is, the point I'm trying to make out from this is that people who contribute voluntarily to the provident fund accounts, they have to assess as to what is the amount they are contributing in a particular financial year. And if it exceeds 2.5 lakh, they just need to be cautious and know the implications of their contributions. Now, the mechanism to compute taxable interest. How is the taxable interest to be computed? Of course, this amendment came in the Finance Act 2021 earlier this year, but the manner of computation, right? The procedure for computation has been only recently introduced on 31st of August 2021. The CBDT, the Central Board of Direct Taxes, came with Rule 9D. Rule 9D has been inserted, and it talks about two things. It talks about computation of taxable interest. Of course, that is the objective. The objective of the rule is to compute the taxable interest. But for computing taxable interest, what the rule says is that two separate accounts within the Provident Fund account have to be maintained from the financial year 21-22 and onwards. So from this current financial year, the EPFO or the private trusts, the PF trusts, they will have to maintain two accounts, right? One is the non-taxable contribution account and one is the taxable contribution account. So this rule applies to, as I said, all the PF trusts, even the EPFO. The EPFO will have to maintain now two accounts, taxable and non-taxable. And further, this Rule 9D, it gives out the contents of these separate accounts. So what are the contents of the taxable account, non-taxable account, are also prescribed, which will be which I have plotted out in this particular slide of mine. So what are the contents of the non-taxable contribution account? So the closing balance standing in the members' contribution account, the closing balance in the members' contribution account as on 31st March 2021 goes in the non-taxable contribution account. So it means that it is not a retrospective tax, it is a prospective tax. It applies from 1st April 2021. That is the implication. To this balance, we add the threshold limit of 2.5 lakh. So contribution up to 2.5 lakh is also part of the non-taxable contribution account. Further, withdrawals, if any, made by the member during the year are deducted, and the interest accrued on this, on all the three balances, is then added to arrive at the final balance of the non-taxable contribution account. What are the contents of the taxable contribution account? So all the contributions during the financial year 21-22 and onwards in excess of 2.5 lakh or 5 lakh, as the case may be, they'll come in the taxable contribution account. Withdrawals, if any, will be reduced, and the interest accrued on this net balance will be added back, and then we'll arrive at the balance in the taxable contribution account. So by splitting the members' account into non-taxable and taxable, the income tax department says that the interest attributable to the taxable contribution account is what is to be offered in the return of income. So that is the whole purpose of making these two accounts. Let us take an illustration. So suppose in this particular financial year, I've taken one of our clients' live cases. So this particular employee had a balance of 9,03,256 as on 31st March 2021. So this is one of the inputs that are required to prepare these two accounts. I also know that his contribution during the FY 21-22 will be 9,60,000, and I have assumed an interest rate of 8.5%, which is the prevailing rate on the PF account, and the interest earned, basis all this, the contributions and the balances, I have computed that the total interest, right, the total interest on the members account is 1,12,902. So mind you, I am only considering the employee's contribution. The employer's contribution I have not considered for our computation purposes, for the sake of simplicity. Now, based on this information, you see this information is there in the accounting system, right? With the EPFO or with the PF trusts, it is already there. From this information, we have to draw these two accounts, which we have discussed, and then compute the taxable interest. So how do we do it? In this manner. So the opening balance of 9,03,000 standing as on 31st March 21 goes to the non-taxable account. Then the threshold limit of 2.5 lakh also goes in the non-taxable account. So out of the 9,60,000 employee contribution, 2,50,000 goes in the non-taxable account, and the balance 7,10,000 goes in the taxable contribution account. Now the interest earned on these two accounts, right? So I will discuss the interest computation in the next slide, but for the time being, let us take this as granted. The non-taxable account earns the interest of 94,131, and the taxable account earns the interest of 18,771. So interest will be added to these two accounts. And from this interest, now this is interesting, and this is one more additional compliance which I'll be talking about. From the taxable contribution account, TDS, tax deduction at source, will have to be done on the taxable interest amount. So the taxable interest amount being 18,771, 10% of this amount is 1,877. That will have to be deducted by the EPFO, by the trusts. There are no withdrawals. We have not assumed any withdrawals. So these accounts sum up to 12,47,000 in the non-taxable account. The taxable account has a balance of 7,26,000, and the total employees account is 19,74,281. Now let us see how the interest of 18,771 has been computed. So what I've done is I've taken the employees' contribution. I plotted the monthly contributions. I've plotted the opening balance as well. This particular person is contributing 75,000 until September, and then there's a salary revision. I've assumed a salary revision, and this contribution then increases to 85,000 until March. So the total contribution during the year is 9,60,000. And these figures, I split into the taxable and the non-taxable components. So 9,03,000 again goes into non-taxable, and the first 2.5 lakh, the initial contribution up to 2.5 lakh goes in the non-taxable account, and the balance then goes into the taxable contribution account. And the feature with PF is the Provident Fund interest is always computed as a monthly running balance. So I've taken the monthly running balance. So 50,000 is the balance because the interest is always computed 1 month in delayed interest. So the monthly running balance starts from the month of August, because the taxable contribution starts from the month of July. I've done the monthly running balance computation, and when I apply the rate of 8.5% on this monthly running balance, I get an amount of 18,771. So I'll just go back to this slide. So out of this 1,12,000, which is the total interest earned, 18,771 pertains to the taxable account, and this has to be part of the return of income, the income tax return. He has to offer this amount in his return of income and compute tax on this. Whereas the balance 94,000 is, because it is part of the non-taxable account, it is tax-free. So there is no tax levied on the amount of 94,131. So only 18,000 is subject to taxation. Now, let us assume the next financial year. The same person, the same account that we studied. Let us assume that his contribution for the next financial year is 11,10,000. And suppose in the month of April 22, he's withdrawing an amount of 15 lakh rupees. Assume that the interest rate remains the same, and the interest that he earns on the total contributions minus the withdrawals, right? Because he is making a huge withdrawal. That is why the total interest that he is earning on his contribution is 81,645. So the question that arises, and this is pretty interesting also, because the rules that have been notified and the amendments that have come, right? Nowhere is this mentioned as to how the withdrawals are to be allocated. So after consulting a lot of senior tax consultants and tax practitioners, we have arrived at a conclusion. I'll just discuss that. So here I have plotted the earlier year's account, which we just saw in the previous illustration. For FY 22-23, I've again made the split into non-taxable and taxable contribution accounts, because these accounts are perpetual accounts, right? The rule 90, which has been introduced and notified, it requires that you maintain these accounts forever now. They have to be part of the member's balance statement and member statement now forever from the financial year 21-22. So my opening balance is obviously the closing of the last year, which is 1247 in the non-taxable account, 726 in my taxable account, totaling to 19,74,000. Again, out of the 11,10,000 which the employee is contributing during the year, 2.5 lakh goes in the non-taxable account, and the balance 8.6 goes in the taxable account. The interest earned on the non-taxable is 17, while that on the taxable is 63. The tax deduction at 10% on 63,000 is 6,390, and the withdrawal is allocated in a manner which I'll be discussing. So again, these two accounts are drawn up as per Rule 90, the contents that are there in Rule 90. Let us look at the interest computation and how the withdrawals are allocated. So his opening balance is 19,74,000 as per the previous computation which we saw. And in the month of April, he's withdrawing an amount of 15 lakh rupees. Now, this 15 lakh rupees is to be allocated between the non-taxable and the taxable account in certain ratio, because the law is silent about it. So the consensus is that first the non-taxable account is utilized completely. So whatever balance stands in a non-taxable account on the day of withdrawal. So in this case, 12,47,000 was standing in the non-taxable account. That balance is to be first utilized for the withdrawal of 15 lakh rupees. So out of this 15 lakh, 12.47 is absorbed from the non-taxable account, and the balance 2,52,000 is absorbed from the utilized from the taxable contribution account. And then of course we have again allocated the contributions. We have plotted the contributions and then allocated it to the non-taxable and the taxable accounts, and then computed the interest based on the monthly running balance. So the amount comes to 63,901. So again, out of the total interest that the employee earns of 81,645, 63,000 is what is to be offered in his return of income as taxable interest. And the PF trust or the EPFO will have to deduct an amount of 10% on this amount. That is 6,390 in our case will be the tax deduction at source. Okay, so now let me discuss what is the return filing obligation by the member and what is the obligation on the deductor, which is the EPFO or the PF trust. So income tax return filing by member, the interest income accruing in respect of the employee's contribution over rupees 2.5 lakh shall be taxable under the head income from other sources. So this is very important. So this interest that the member earns on his own contribution is income from other sources, right? Even though it is coming from the PF account, it is not salary income, it is income from other sources. And it has to be shown accordingly in his return of income. An analogy can be drawn, similarity can be drawn with the interest that a person earns on a fixed deposit. So this is similar to that, not exactly like that, but it is similar to interest on fixed deposit, which is also part of, which is also taxable under the head income from other sources. Now the member needs to offer taxable interest income in his annual return, and after taking into consideration the amount of TDS which is deducted by the EPF or the trust, the member will have to either pay additional tax in the form of advance tax or claim a refund. So this is also one of the important things. Why? Because most of the people who are affected by this provision, they will be falling in the highest tax slab, 30% tax slab, 30% and cess and surcharges if applicable. However, the tax deduction at source happens at the rate of 10% only. So the remaining 20% or 20% or so will have to be offered by the member in his return of income, will have to be paid as advance tax or self-assessment tax, as the case may be. So this is very important from the member's perspective, from the employee's perspective, because the employee will have to compute that advance tax or make a tax computation and pay it in advance to avoid any interest on short payment of tax. So this is one important point that I wanted to make. Now, what is the obligation to deduct tax? We have seen that taxable interest shall be subject to 10% TDS under section 194A. So this is a section where this particular TDS provision is triggered, and this particular provision is triggered only if such taxable interest exceeds 5,000 rupees. So this is the threshold limit. So only if the interest paid is more than rupees 5,000 is there a need to deduct tax at source at 10%. Now the EPF or the RPF needs to deduct tax at the time of credit of taxable interest. So now what is the time when how frequently is this tax is to be deducted? It is to be deducted only when the interest is credited into the PF account, which is usually at the end of the year, right? Because interest is not credited on a monthly basis or a quarterly basis. Interest is always credited at the end of the year. So deduction is also at a point in time, is also once in a year. And Form 16 will have to be issued. So whoever deducts tax, under section 194A is required to, draw up Form 16, issue Form 16. Actually, he has to download this Form 16A from the Traces portal. But nevertheless, this is also a compliance which has to be done. So this was about the taxation of interest on employees' contribution. Now the next topic which I am covering is the taxation of employers' contribution to provident fund and interest thereon. So this was not so a recent amendment. In fact, it was introduced last year in the Finance Act 2020, where the employer's contribution was also subject to taxation. So the Finance Act 2020 introduced a tax-free cumulative upper ceiling of rupees 7.5 lakh, being employer's contribution to 3 funds, right? So now we are considering here 3 funds. We have the Provident Fund, we have the National Pension System, NPS, and we have an approved superannuation fund. So whenever there is a case that the employer's contribution, now we'll be focusing on the employer's contribution, right? Whenever the employer's contribution to these 3 funds taken together exceeds 7.5 lakh rupees in a financial year, then this particular amendment comes into effect. And tax is to be levied. Now the definition of perquisite was changed. Okay, the definition of perquisite. Now how this amendment was introduced in the Income Tax Act. The perquisite is defined under section 17. It is as good as salary, so we can interchangeably use as salary, although not exactly in technical terms. So the definition of perquisite was changed to include contribution by the employer to these 3 funds in excess of 7.5 lakh rupees. So section 17, subsection 2, clause 7 was introduced, where the interest, dividend, and other income earned during the year on above mentioned excess contribution will be treated as taxable perquisite. So here, in this particular amendment, there are 2 things which are taxable, as compared to the interest that was taxable earlier in the earlier topic. We were concerned only about the interest that was earned by the member. Here, in this particular amendment, we are concerned with 2 components of tax. One is the contribution itself that is subject to tax, and the other is the interest that is earned on these funds. The income that is earned on these funds, which is subject to taxation. So this is the amendment section 17, subsection 2. Clause 7 and clause 7A have been inserted to tax the contribution and the interest earned on these contributions. So again, now what is taxed? It is the contribution that is taxed in excess of 7.5 lakh, and it is also the interest or the income that is earned. And why do I say income earned? Because these 3 funds. The Provident Fund earns interest, obviously. National Pension System is a NAV-based product. It is not an interest-bearing investment. And of course, it's an NAV-based product, but the underlying assets may earn you interest or dividends. But primarily, this particular investment gives you an increase in NAV, or even a decrease in NAV. Superannuation fund may earn you interest, or it may also be an NAV-based product. So that is the reason. What is taxed is not only interest, but dividend or income earned on these 3 funds. So this particular amendment is crucial in the sense that the amount of contribution is also taxable. So the amount of tax is much higher as compared to the interest on employees' contribution. Now how do we compute this? How do we compute the interest that is earned on this contribution? We know, the employer knows the amount that he contributes in excess of 7.5 lakh. It is pretty obvious. So suppose the employer is contributing 8 lakh rupees, then only 50,000 is subject to tax because 7.5 lakh is a threshold. But how do we compute the interest that is earned on 50,000? So that is something that we need to compute. So the CBDT came out with a notification dated 5th March 2021, wherein the mechanism to compute the annual accretion, which we have described, is provided. So they have come up with a formula, right? This particular formula says that this is the formula that is we are seeing on the screen. TP is equal to PC divided by 2 into R plus PC1 plus TP1 into R. So all these are technical terms, and the definitions are also given. So what it says is that this is the formula that everyone has to apply. You don't have to apply any other formula. You don't have to do any other mode of computation. This is the only way that you have to compute the income earned on the contribution in excess of 7.5 lakh. So we'll rather take an example and see rather than just going with the definition. So I've taken a case of a person whose contribution is contributing to the PF account, and his contribution exceeds 7.5 lakh. What I've done is I've summarized his PF account for 3 financial years: FY21, FY22, and FY23, because this provision starts from FY21 onwards. So this particular person starts with a nil opening balance. The employer is contributing 8,70,000 during the financial year to this particular account. The employee is also contributing a similar amount. I have not assumed any contribution to the pension amount. The total contribution is 17,40,000, and the total interest that is earned on this particular balances, these particular contributions is 66,512 rupees. So similarly, I've summarized for the next 2 years also with the employer's contribution, the member's contribution, and the interest earned on that. Now, when I apply these, when I actually solve that equation, which is notified by the CBDT, and I plotted the equation over here, and when I actually solve it, I arrive at the taxable perquisite. Taxable perquisite is nothing but, in our case, the taxable interest. So, for instance, in the financial year 21, out of this 66,512, I have to tax an amount of rupees 4,418 rupees. So the balance 61,000 is tax free. So that is what is implied by this particular method. So similar when you solve the equation for the next 2 financial years, the taxable interest comes to 17,000 and 42,000 respectively. So the mode of computation is very different, for the employer's contribution as compared to what we saw in the employee's contribution. So all these computations will have to be built into the accounting systems of EPFO. Now, in this case, how is the income taxable in the member's hands? It is taxed as income under the head salaries. This is very important. So employer's contribution and interest that is taxable, that is computed, is income chargeable under the head salaries. And the employer will have to issue Form 16. The employer will have to incorporate those details in this Form 16, which is otherwise is also required to issue. So this is one additional compliance which comes with the introduction of this amendment. Tax deduction at source by the employer or RPF. So what are the implications? TDS attributable to the taxable contribution and perquisite shall be deducted by the employer and RPF respectively under section 192. So because this income is taxable in the hands as salary income, the tax is also deducted like any other component of salary. It has to be deducted on a monthly basis. Again, that is also an important point. Because in the earlier topic, in the employee's contribution topic, the point of tax deduction was at the end of the financial year when the interest was credited. Unlike in this particular case, the tax will have to be deducted on a monthly basis by the employer, depending on the contribution and the interest. So this is one. So a prudent approach for the employer will be to anticipate, because salary taxation is always an anticipation. The tax, the tax that is deducted in the month of April or May is always in anticipation of the employment for the whole financial year. So anticipation is very important for deducting tax at source. Now, as consultants and as advisors, what are the trends that we are seeing? What are the consequences that we are seeing in the industry because of these amendments? So the first thing that we are observing is that the voluntary contributions of people have reduced, or people have completely stopped their voluntary contributions. Some people have reduced or restricted their contributions. So this is a very visible trend that we are seeing in many of our clients. Why? What is the reason? Obviously, because they will be subject to taxation, and because of the tax, the post-tax interest, the interest rate of 8.5% seems very good, because I'm sorry, I'm just yeah. The interest rate of 8.5% seems a very, very good interest-bearing security. But because of the tax that is introduced, someone who is falling in the highest tax slab, someone who is falling in the 30% tax slab, when he actually pays the tax, he only earns an effective interest rate of 5.85%. So this is something which all the employees, all the members have taken cognizance of, that the effective interest rate is 5.85% only, right? Because of the taxation that has been introduced. And this is as good as any FD rate, or even slightly better than the FD rate, I suppose. Now, contributions in excess of 2.5 lakh are diverted by most of the members to equity instruments. That is also a trend that we are visibly seeing, either to NPS or mutual funds or market linked products, but they are not contributing to the PF accounts. We also had many of our clients who have revised their payroll structures. They have revised their payroll structures in such a way that the total PF contribution is 2.5 lakh annually. So these are some visible trends which I thought I would discuss that are very visible in the industry. Now, what are the additional compliances or what are the changes that are required by the employer, by the EPFO, by the RPF? Now, because all these computations have come up, and the computations are pretty complex. It may not be very complex, but they are pretty complex. The accounting systems have to be tweaked, and that is one of the additional compliances which the EPFO or even the PF trusts, the independent PF trusts will have to incorporate. They'll have to compute the taxable components, the non-taxable components. They have to compute the taxable interest, the perquisite, as we discussed. Then there has to be a mechanism to deduct tax at source also. So the tax consequences are pretty obvious on the employer, on the EPFO. And the members account statement also, right? Because the members account statement will also have to reflect a taxable account and the non-taxable accounts, which we discussed. So all these compliances are an additional sort of a burden on the employers, on the EPFO, on the trusts. Also, they have to comply with the issuance of Form 16A, Form 16, payment of taxes to the government within the time frame that is required. So these are additional compliances. Now, what are the practical difficulties? Now, all this was an ideal scenario up to now. The computation was pretty much systematized, but there are some practical difficulties. It is not so easy. Now, what is happening is now this trend has been there for many years. The EPFO, for instance, take for instance the financial year 2021. The rate of interest for financial year 2021 is not yet notified by the EPFO, and we are in the financial year 21-22. Almost half of the year is gone. More than half of the year is gone. But the rate of the interest has not been notified for the previous financial year also. So till the time the interest is declared, right, the taxable interest cannot be computed, because for me to compute taxable interest, I should know the amount of interest, and to know the amount of interest, I should know the rate of interest, which has not been yet notified. Of course, they have proposed a rate of interest of 8.5%, and there are news reports that are going on. But these news reports have come, very recently. The notification has not been come. No circulars have been issued as of now. So obviously, I cannot offer that taxable interest in my return of income for 2021 as of now. My return filing date usually is 31st of July. And of course, this has been that date has been extended because of the pandemic situation and of course for other reasons. But generally, if I do not know what is my taxable interest till the date of filing return of income, then how do I actually offer it in my return of income? So that is one important thing that the EPFO will have to consider, and this is a practical difficulty that every member will have to face. So by the time the interest is credited to his account, the date for return filing is already gone, and there is obvious non-compliance. So similarly for the employer also, it is a matter of non-compliance, because the amount of tax deduction at source that is to happen, that cannot happen till the amount of taxable interest is computed, and the TDS date is already gone, right? So there will be non-compliance if the same trend continues. If the EPFO does not declare the rate of interest on time, this non-compliance will always be there. The members will not be able to compute the return of the taxable interest, nor the employer or the trust will be able to compute the right amount of tax to be deducted. So this is one practical difficulty. In fact, many practical difficulties which the employees will have to face, the employers and RPF also. So that was the taxation of the employer's contribution. I come to the third topic, which is taxation of PF withdrawals. Now this has been there for quite some time. Actually, this is not a recent amendment as such, but I thought I'll just touch base on this also, just to have a holistic view of the topic as such. So withdrawals made after 5 years of PF membership. So this is the criteria. So when are my withdrawals taxable? If the amount standing to the credit in PF account is withdrawn after 5 years of continuous service, then the entire amount shall be tax-free. This is what the 4th schedule of the Income Tax Act says clearly, that in order that the withdrawal is completely tax-free, right, there has to be 5 years of continuous service. So this is the thing. So obviously, if the withdrawal is made before 5 years of PF membership or before 5 years of continuous service, there is taxability. And what are the three components that are taxable? The employee's contribution, the interest on employee's contribution, and the employer's contribution. So how is the employee's contribution taxable? So whatever tax benefit that the employee has claimed, so we are talking about the case where the employee withdraws the PF corpus before 5 years of membership. In that case, whatever his contribution, right, whatever the portion of his own contribution, which he has claimed as a deduction under Section 80C in the earlier years, right, in the earlier 4 years, 5 years, 3 years, whatever, will have to be offered as taxable income. That amount will have to be offered in the taxable income of the year in which the withdrawal is made. So that is how the employee's contribution is taxable. Of course, there can be a situation where the employee is not claiming 80C deduction for his PF contribution. In that case, none of the amount will be taxable. So only to the extent that the employee has claimed 80C deduction attributable to PF contribution will there be that reversal of such benefit that he has taken in the earlier years. How is the interest on employees' contribution taxable? The interest on subscribers' own contribution is taxed as income from other sources. Again, so this is another head of income in his return of income from other sources, where he has to take the interest on his own contribution. How is the employer's contribution and interest taxable? It is taxable as salary income. So this is like pretty straightforward. So the three heads of income have to be accordingly offered in his return of income. Now there is an exception. There is an exception to the rule that if the withdrawal is made before 5 years, there is no taxation. And what is that? What are the circumstances? One is the employee's ill health. So suppose he withdraws before 5 years on account of his ill health, then nothing is taxable. Nothing is taxable if there is discontinuation of employer's business, and if there are reasons beyond the control of the employee, then also nothing is taxable. So for these three reasons, that criteria of 5 years continuous service is not applicable and no tax is levied. So just to summarize, so if the PF amount is withdrawn after 5 years of continuous service, then all the components are exempt, right? If before 5 years of continuous service, then the employee's contribution will have to be offered as salary income in case Section 80C deduction under Section 80C is availed. If 80C deduction is not availed, then nothing is taxable. Employer's contribution will be taxable as income from salary, and the interest earned on employer's contribution is taxed as salary income. The interest that is earned on employee's contribution is taxed as income from other sources. So these are the few things that one has to remember. Now I come to the TDS obligation on the EPFO. So this particular slide. So the EPFO is obliged to deduct tax under Section 192A. TDS at 10% has to be done by the EPFO at the time of withdrawal of PF corpus, if such withdrawal is made before completing 5 years of continuous service. No TDS will have to be done in certain situations. So suppose the withdrawal amount is up to 50,000, then there is no TDS obligation on the EPFO. If Form 15G, 15H is submitted by the member, then also no deduction has to be made. If the PF balance is transferred obviously to any other recognized PF, then obviously there has to be no deduction. And again, for these three reasons, due to ill health or discontinuation of employer's business or reasons beyond the control of the member, if the withdrawal is made because of these three reasons, then also no tax is to be deducted by the EPFO. Now, for the independent PF trusts, a lot of employers have PF trusts. The TDS obligation falls under Section 192 and not under 192A. So these trusts will have to deduct tax at the average rate of income tax in case the withdrawal is made before 5 years of continuous service. If the withdrawal is made after 5 years, obviously there is no obligation to deduct tax at source. The amount of tax shall be deducted and paid as if the accumulated balance paid to the employee were income chargeable under the head salaries. So the PF trust which is deducting tax will have to take into account the slab rates. That is what is implied by the last sentence. Because this income is to be deducted as salary income, the rate of income tax will be the average rate of income tax computed as per the slab rate applicable to that particular employee. So the TDS obligation for the EPFO and the PF trust are different in case of withdrawals. So this was my short presentation on the PF tax implications. I'll be glad. I know it was a pleasure. Thanks for the patient listening. It was a pleasure to talk to you, and I'll take questions.
Okay. Thank you, Vikrant. That was very detailed and very helpful. I'll see if there are any audience question. Very interesting. A lot of clarity. There are no question, all appreciations only. I would like to just share a couple of things for the benefit of viewers. One is, as Vikrant mentioned, that if a member withdraws before 5 years and it is due to some reason which is not in control of employee, then in that case the amount is exempt. But in most cases, the employer either mentions a wrong reason or there are few reasons which are not even available as an exit reason. In that particular case, TDS can still be deducted. What a member should do in case that was a sort of not his choice, then but still the TDS was deducted. Yes,
TDS was deducted. Yes. And I'm also aware, like not every member has the capacity to fight it out with the legal authorities or tax authorities. So I think in that case, what he has to do, I think, because the tax has already been deducted and paid by the employer is not going to give him that money anyways. So I think the only approach that he can do in such a situation is to claim a refund. In his return of income, when he files the return of income, he can actually claim a refund to the extent that the tax is deducted by the employer. I think that is one way, and if someone is able to fight it out with the help of a professional, then I think that would be one way.
Okay. Second thing, you mentioned that the employer contribution, which is 7.5 lakh, it is not only the contribution, but the interest is also taxable. How the contribution is taxable?
So in our example, that the employer's contribution is, say, for example, 8.5 lakh rupees for a particular financial year. Then 8.5 lakh rupees minus 7.5 lakh, because 7.5 is the threshold limit. So 1 lakh is the amount that is to be taxed as income from salaries, because that becomes part of the perquisite. So definition of perquisite has been amended. So it is deemed to be a perquisite, taxable in the hands of the employee.
Okay, so does the contribution comes after the TDS deduction, or the contribution of full 1 lakh is paid to, say, NPS or EPS, and then 30,000 or whatever the contribution is by employee, that has to be paid by employee himself as an advance tax liability?
Yes. So he'll be getting. So what happens is the employer will contribute 1 lakh rupees in our example. He will not deduct tax on 1 lakh. I mean, he'll be deducting tax from the payroll. Right, he'll be reducing the contribution, because I suppose he cannot reduce the amount of contribution. He'll be paying the whole gross amount of contribution in his PF account, but the payroll tax will be increased to the extent of the tax on contribution. So his salary will be reduced. His monthly salary will be reduced to the extent of the tax on the contribution. And because this is salary income in the hands of the employee, and the employer is obliged to deduct tax as per the slab rates. There is no fixed rate of tax to be deducted. So he has to take into account the applicable slab rate. So I suppose in that case, there will be no additional tax liability, tax to be paid by the employee, apart from the TDS.
Wonderful. And as you rightly mentioned, this topic is very complicated. For most general public, it is. But on the brighter side, 99% of employees are not affected, at least for now, are not affected by this amendment. So they can relax. It just creates some trouble for probably HRs and the tax professionals who actually have to do the heavy lifting. Thank you so much for your time, and it was pleasure hosting you here as always, and hopefully we'll connect in future again. Thank you so much.
Thank you, Rishabh. Thanks for your.
Thank you, Vikrant. तो दोस्तों, उम्मीद करता हूँ आपको आज का वेबिनार पसंद आया होगा, और आपके क्वेश्चंस कुछ खास इसमें आए नहीं है तो कोई दिक्कत नहीं है. अगर आपके कोई और क्वेश्चंस हो तो आप जरूर हमारे साथ ग्रुप पे भी ये डिस्कशन शेयर कर सकते हैं. मिलेंगे अगले 31st वेबिनार में, तब तक के